It will be recorded. The most important thing I can say, though, from my job, and then I'll shut up, is options involve risks. They're not suitable for all investors. Everything we're about to be talking about is backward looking and not forward looking. So, as always, consult with your financial advisor before engaging it because everything presented today is for informational purposes only. When Tammy's speaking, it's informational purposes. When I'm speaking, it's entertainment purposes. So, with that being said, I will go ahead and hand it over to Tammy and we will go from there.
Okay, let me share my screen. And so, okay, as Troy said, there these are my results from last year. So you can see it's a pretty steady income with very low drawdowns. And that's what I love about this strategy. It provides you good returns all the while being low drawdowns. And I want to add on to what Troy said. What I'm showing you is how I do things. And the goal for me sharing that is for you to understand the reasoning behind what I do so you can make your own decisions as you're trading. The goal is not to copy me, it's just to understand what I'm doing so that you can make your own decisions or trade like I do or trade like you want to. I just want you to understand the thinking behind this. And if you just copy me, you will fail because you won't understand the decisions behind why I'm trading the way I'm trading. If you understand my reasoning, you can decide if that makes sense for you or if you want to use different reasoning. And I will often point out this is the way I do things. You could also do this other way, perfectly fine. It's just a personal decision. Troy said this class is for informational purposes only, and it's not investment advice or intended to be investment advice. And any trades you make based on this information are your responsibility alone. We disclaim any liability, loss, or risk for use of this information. I wanted to talk about drawdown, the definition of a drawdown. It is not just one or two losses, it is a series of losses, and the drawdown is calculated from a recent high to the recent low, and then a period of recovery back to when you start making new highs again. So the drawdown is at the peak of the drawdown. A lot of people they use drawdown incorrectly, just meaning a few losses in a row. Yes, that could be a drawdown, but it really is intended to be a long series of losses before you start recovering again. So I wanted to share that. And let's see, I've got a few other things there, but let's start off and I'm going to be flipping back and forth between my trade screen and what I want to talk about because I have some active trades on right now. So one of the things I'm going to do right now is go to my accounts, and I only entered 3 trades in this one account, and one of these the long option is worth less than 5 cents, so I need to remove that from the stop and reset that stop. So I'm going to do that right now on this one and stop, and then I'm going to set that for $1. And I'll talk about this after I do this. That's the only one in that account I need to do. And I've got one other account that looks like it's fine right now. So I just want to keep an eye on those since we've got some trades and since it's near the end of the day. Let me get back to what I wanted to share. So let me just scroll down here. And all of these things are things I will be sharing. One thing I wanted to talk about was what I do each day. Those who attended the November and December classes, we were trading in the morning, so they got to see me entering trades live. You'll see me managing the trades at the end of the day, which is actually a more active period of time. But what I do when I start my trading day is first thing is I look at how the market's behaving, and I'm gonna bring this screen over here. And today I almost didn't trade because we saw this 15-point drop at the open, then a 30-point gain, then an immediate 10, 15-point drop, then it gained back, and then another 30 points down. That's a pretty choppy day. And then it flattened out and fooled me. And I start entering, I was going to enter 11:45, but I skipped that because of that volatility. That probably would have been a fine trade to enter. But I started entering at 12:15. These are all Central Time, 15 Central Time. And then that trade immediately went against me. And then later, these puts stopped out. These are the short strikes that I've marked on the chart here. And so you can see where I've stopped out. And I'm going to have a small loss today in two accounts, unless it continues to bounce around. We'll see. It looks like it's settled down here. So I may try re-entering or entering another trade in one account just so you can see me do that. But one of the things I do look at is volatility. And today was borderline. It did settle down there, which was encouraging, but then it got volatile again. So today really probably would have been a good day to skip. It's hard to know that in advance, but you just have to make the best decision you can. Let me move this screen over. And then I'm going to call up my trading, this account, trust, and I'm going to go ahead. I've got this set up to enter 4 contracts. Let's just see what the pricing is. And I'm just going to enter in this one account. So 4170, yeah, I could probably, I'm just going to go far 65. Let me see. So 70, and I'm just going to go 25 points out and do 65 cents, which is really pretty low, but that's just what it is at this point. And let's see. Normally I enter the side we're moving away from first, and we'll see if we can even get in this trade. So it may fill here. There we go. 0.70. I'm going to write this down in my trade log. 0.70, 0.05, 0.65, 47.70, 47.95. And I'll talk about what I'm doing in a little bit. But now on this other side, I'm going to, I've got to get rid of some of these Zoom controls. Just a second. Cancel that. Okay, and then so we got 65 on that side. Probably not going to be so lucky on this side unless I 40 and 65. Yeah, I may just do that. 75, 80. We'll do that because it gives me a good example to show you. 47.55, 47.50, and that got in, so 142 and 62 cents. I'm going to log that in. Okay, so I got 80 cents on one side and 65 on the other. Since those credits are unequal, I'm going to combine the credits, 0.80 plus 0.65, and subtract 10 cents. That's 145. And that's probably going to stop me out really fast here, but we'll see. So 145 on the, and let me enter this one. That would be, oh, sorry, it should be, let's see, 65, 120 on that side. Is that, did I do that right? 145, that should be 130. Yeah, that's gonna modify. That's probably gonna stop me out pretty quickly here. 130.
There already.
Yeah, no, I'm there already. Let me do 140 just to get it away from there and get a stop on. 40. That'll probably kick me out real quickly, but we'll see. Okay, now that I've entered a trade, I'm going to go record it. And here, 47.70, 47.95, 0.70, 0.05, 47.55, 47.50, 1.42.62. Let's see, if I get stopped out at 130, that'll be minus 207, and I collected 250 on the other side. So that'll be fine. So we'll just see if that plays out here. Okay, so let me go back to, now that I've got that done, I just want to keep track of things here because see, that's gone down and now worth less than 5 cents. So I need to really take that stop out. Cancel 47.70, 20. And I think I've got to stop for 4. I just want to do 4 at 120, I think is what it was. Oops. I set that wrong. Close. Stop. 120. I'm doing it here just a second. I see what I'm doing wrong. 4. Stop. 120. Okay. So now I've got those 2 stops on. And I'm going to go ahead and cancel this one too because it's so close. So it's going to go down to be worth less than 5 cents in just a few minutes. So that's the stop is 260 at 47.40, and that is only 17 cents. So I'm going to set the stop at $1 here. Again, I'm going through this pretty quickly and I'll explain what I'm doing in a second. So let me check my other account. That's still 7.5 and 7.5 cents. So still okay. Okay. Hopefully you have all watched the video on M.E.I.C, the Multiple Entry Iron Condor. And is there anybody who has not watched that? And just put it in the chat or open it up. Okay, good. I'm not seeing anybody who has not watched that. The idea behind M.E.I.C is you enter an iron condor, and then let me open up this. This will show it. You enter an iron condor, and you use a 1x stop on each side. So you set the stop for 2 times the initial credit for a 1x net loss on each side. So if you get stopped out on one side, the loss from that side is covered by the gain on the other side. So hopefully you'll end up at break even. Ideally, both sides would end up expiring worthless at the end of the day, and you'd take home that profit. Excuse me. But very often you will stop out on one side or the other, but that will create a break-even trade. The idea behind M.E.I.C Plus, and I abbreviated M.E.I.C, M.E.I.C Plus, is that I set up my stops so that even if I stop out on one side, I will collect a little bit more on the other side than my stop is on the other side. So let me show you how that works. I'm going to just enter some hypothetical trades. Let's say we entered, excuse me, 4,500 calls, really doesn't matter, 4,550 calls. Let's say we got $1.50 and 20 cents. And then on the puts, 40.80 and 44.50, let's say. Okay, so if we collected 150 on the long and on the short, and the long option that we buy costs 20 cents, then we're even and no problem. And what I will do is, rather than set the stop at 2 times that initial credit, I'll multiply that times 2 and subtract 10 cents. So that would be a stop of 250. So if I got stopped out at 250, then I would make, on the other side, let's say I've done 4 contracts, on one side, I've made $515. And on the side I lost on, I only lost $478. So I'd take home a profit of $30, even on a trade that broke even. The idea behind C is that, let me get down here. So many of these trades end up break even that I thought if there's a way to profit on these break even trades, then I'm not gaining just when I win on all the winning trades. I'm also making money on the break even trades. And the only time I'm losing is when I have a losing trade or losing day. That's the idea behind M.E.I.C Plus, is setting the stop slightly smaller than a 2x net or 2x stop so that you collect a little bit. Let's go over some variables then of things that could happen. Let's say we collect a little bit more, like on this side we just did. We collected 70 cents and 0.05 and then 1.42, 62. That was our trade. So we ended up collecting 80 cents on one side and only 65 on the other. Now, I could have done 5 contracts and those would have been more even, which is ideally what I like to do. But sometimes I don't have the foresight to realize that I needed to do 5 contracts. So I ended up with 4 on one side. So in that case, I combine the credits and then I set the stop for 80 plus 65 is 145. And I set the stop for 10 cents less than that. So 135. So even if I stop out on that side, I'll still make $30 on the trade. The difference between the 255 gain on one side and the 227 loss on the other. That would be a $27 gain. Now, on this side, the lower credit side, I just set the stop for 10 cents less than 2 times the initial credit. 2 times the initial credit, 65 would be 130, and I set the stop for 120. Again, if I get stopped out on the call side, then I'll make a nice profit of so $90, almost $90 there. So that's the idea behind M.E.I.C. Now, it works better when I usually don't like these credits that are less than $1, but sometimes, like today, especially toward the end of the day, this late in the day, you just go for what you can get. I don't know that I'd want to be right at the money on those when I'm selecting those strikes. Like I could have gone to the 47.60, and we're trading just right below 47.60 right now. So I don't know that I'd want to be that close to the money. And so that's one reason I went a little bit further out. I just get what I can get at that point. And same thing on the other side. But so there's several ways to do it. I could increase my number of contracts on the call side to 5 to get a more even credit. And then if I did that, 5, and then again, I would just still set my stop for 2 times the initial credit. You can see that the initial credit on one side is 325 and on the other side is 320. So if I set my stop for 120, then let's see. Gain on the other side, it's not adding the gain here. Let me see here. I may have deleted something. Yeah, I deleted something inadvertently. So if I had done 5 contracts on one side and 4 on the other, so the total initial credit is very similar, then all I have to do on both sides is set the stop on each side for 10 cents less than 2 times the initial credit. So that side, if we set it for 120, the loss would be, we'd gain about $25, $30. If the loss on the other side was 150, the same difference. So we'd lose a little on the losing side, but we'd gain more on the gaining side. Many of these trades end up break even because you are using a 1x stop. So they do tend to stop out pretty often. And so but as long as you're making a little bit of money, I don't mind trending days because I can really, if I made $30 on every trade I entered, usually I'm entering 5 or 6 trades, that would be 100 and something dollars on $150 on a trading day. I'd be fine with that. And I trade 3 different accounts and I trade different number of contracts in each account. That just shows how you can manipulate the stops. I want to go back a little bit to what I do at the start of the day. And like I said, I look for choppiness. And today was borderline. I almost didn't trade, but because it flattened out here, I decided I'll go ahead and enter. And so far, so good. It's been about a break even day. I think in TAT, I've had one more stop out than gain. Yeah, I've had 5 stop outs out of 8 entries, so one more stop out. And I will show you. TAT is Trade Automation Toolbox. I have one account that I do automated trading in, and I will show you guys how to use this and set it up and talk about this in the next session. I'm not going to go over it much today other than to show it. And then let me go check my other accounts and make sure where we are. Yeah, there's one that's the calls are less than, oh, nope. Now they went back up. We'll see where this one is. Okay, we're good there. Let me see where my chart is. Let's see. My last entry was 47.70. Oops, just got stopped out. Let me of the 50 and 55. So 235 and 95. 235.95 at 140. And I had a 140 stop, so that's no slippage on that. So yeah, I'll have a small loss today because I had some trades that had more slippage on them earlier. Let's just check. Yeah, I need to get rid of these. So I'm gonna change the stop on these. 47.70, 47.75. And both of those are less than $1. Whenever the credit on the short leg is less than 20 cents, I set the stop. I tighten up the stops and I set that for $1 minimum, usually. That gives it room to move around, but it reduces my loss if for some reason the stock turns around and does go in that direction. My loss won't be as large as it would have been with a 2x loss. Now, the downside of that is sometimes that could hit. By tightening it up, I may be increasing my odds that I get stopped out on those. So that's a decision. I know I have a friend who he just leaves the stops at 2 times the initial credit because of that. He doesn't like it when I've got $1 stop and it hits and you take a small loss on those trades. So he'd rather take the chances of having those expire worthless than to have those stop out at $1. So these stops are still the original stop. And those, okay, they're still worth 7.5 cents. It's 230. Those are going to decay pretty quickly, but yeah, we're good on that trade. Okay, so another thing that I do at the beginning of the day is I check forexfactory.com. Let me go here. Sorry. It's forexfactory.com. This is a news website that I just keep it up on my iPad at all times. And if you use this calendar, it shows the announcements for today. and I can filter it for, let's see, I'm used to using this on my iPad, so let me find the filter there. Okay, so normally what I do is just say none and then US, and that will pick up all the US announcements. So tomorrow, I probably will not trade because there are announcements at 9 o'clock. There's the beige book at 1 o'clock, and that can sometimes move the market. And there's a FOMC member speaking at 2 o'clock. And the market has just been pretty choppy. I'm going to skip Wednesday and Thursday. I usually don't trade on Thursdays because historically, in looking at my trade log, like I have lost more than I've won on Thursdays. So there's something about Thursdays, and even Tasty Trade has noted that for zero DTE, there is something that happens on Thursdays. Usually there's CPI and PPI that come out Thursdays. This week it's unemployment claims, but usually whatever it is, Thursdays tend to be more volatile and it could be because of the news, it could be something else, but they just tend to be more volatile. I would avoid trading Thursdays. You could paper trade Thursdays and see how you do and just keep monitoring it, which is probably what I need to do. But tomorrow there's just so much news, and that beige book can sometimes cause the market to jump. I'm probably going to skip tomorrow too. Usually, like my entry times, and I'll go over how I determine my entry times. Usually I start entering around 11:45 Central Time, which is 12:45 Eastern Time. So most of the time all these announcements are out of the way by the time I start entering. And like tomorrow, if except for that one speaker at 2 o'clock and the beige book at 1 o'clock, everything's out of the way by the time I start entering. And Fridays, there's some news that comes out at 9 o'clock, but then nothing comes out until 3 p.m. And this is Central Time, and that's after the market closes, so it won't affect our zero DTE trades. But you can filter through. I don't trade on any days where there's FOMC meetings and announcements, or it's really the conference call. They can have a meeting as long as they're not making any announcements. And the FOMC conference call and FOMC minute releases, I don't trade on those days because very often, especially right now when there's uncertainty about what's going to happen with interest rates, the market can be jittery on those days. So I avoid those. But next Wednesday, I'll probably trade because there's the news that comes out is coming out pretty early, and then there's crude oil inventories that come out at 9:30, and then it's a couple hours before I even start entering. Monday looks like it'll be real good because the only thing is that CB leading index, whatever that is, and you can find out more information about it. Conference board leading index, and the yellow versus orange versus red tells you the relative impact that it can have on the market. So red is high impact announcement, orange is medium impact, and yellow is not likely an impact. Although that beige book that we see tomorrow, I've seen that have a pretty big impact. So I'm a little less certain about that one. If the day is real smooth and not choppy and just nice and steady, I may trade tomorrow. I'll see how it goes. But that's what I look at on the Forex Factory to make my decisions. And then when I'm entering, let's go over that a little bit. Let me check some trades here. Yeah, I need to get out of that one. Cancel the 47.70. And I'm going to modify that to include all 8 positions at $1. Okay. Okay, and then that account, I'm out of all long positions, so that's good. This one, let me check. I need to get out of that one. Cancel 44.40. And close that. 8. Stop. $1. See, it's worth less than 20 cents. So I'm going to tighten the stop to $1. And then that's still 7.5. I'm going to go ahead and get out of these so I don't have to think about it. And especially since it's only worth 20 cents now, that's going to decay pretty quickly. So 47.45. Cancel that one. And let me set a stop for $1 on that. And then, okay, I've got the stop set on those. 1 and 1. Okay. So now I'm out of all my long positions. I just have stops on the short leg set at $1. And so everything should be good the rest of the day. Let me check how these are doing. So those are all good. And let me see what the chart's doing. So we're just floating around. I didn't duplicate. I didn't put that we got out of that one. So that's the one that we stopped out of. So that trade is still good. Okay, when I am entering a position, let me go to the.
Can I ask you a short question?
Sure, yeah. Anytime, interrupt me. Feel free.
I just wanted to ask, you said that in the beginning, you said when we check volatility, what is a choppy day for you? What is the criteria for choppy?
What I look at is anything where it's moving around up and down, I'd say more than 15 points. Like this, it went down 15, then up 20, 25, and then it went down 30. That's a choppy day. That's why I was undecided about whether I wanted to trade. And then it flattened out and it got less choppy. Of course, right after I entered, it got choppy again, stopped me out of some. But it's really about that 15 to 20 point move that I would like to see those not happen, or at least if they happen in the morning, because sometimes the morning can be pretty choppy, like this can be a pretty typical morning. But by the time I start entering, as long as it's getting flat and flattening out, and there's no news expected the rest of the day, and there's nothing that's going to cause the market to have a knee-jerk reaction.
But if I remember correctly, that it's pretty new that you're starting that late. So last year you were also trading early in the morning. So then you cannot really wait.
That I don't like trading early in the morning. I tried it for a couple of months, but I was just always getting stopped out of those positions on one side. I will say that. Most of the time I didn't have a double stop on those, but I had a lot of single stops. I really prefer entering in the afternoons because of that, because we can have a market direction change around noon, but like today it just was choppy. It's just up and down and up from the high here of 47.68 to a low 47.48. That's a 20 point move down, and then we got another 15 point move back up. That's chop. That can stop you out of both sides. Trending days, I don't mind, because as I can get stopped out on one side on all the trades and still make money. Where it hurts is when I get stopped out on both sides. That's when I start losing money. And like in this TAT account, I've stopped out of 5 of my 8 trades that I entered, and that creates one more loss than win. So I had one double stop in here where both the calls and the puts stopped out. And then here the calls made it, the puts stopped out. So that one was basically a break-even trade. And here the calls stopped out and the puts made it so far. And that's a break-even trade. And here the calls stopped out and the puts are still in. That's a break-even trade. But because of that double stop, I'm down money. So it's that double stop. When you have one more stop than win, it creates a losing day.
Okay.
It's not much. I'm trading 3 contracts in this account. And I really recommend when you start trading this, if you haven't traded M.E.I.C, start it by paper trading first and get used to the number of entries. And let me show you something here too. One thing that I do is I write down my entries and the stops. This was earlier in the day. I've had more entries than this, but I write down the entries, and then when I get stopped out, I write down what those stops were. Excuse me. And then when I have time, I'll go enter those in. This is the trade log I'm using right now. This is another trade log I used to use, and I like it because it can give me some good feedback. I like to use it when I'm teaching because I can fill in the blank on a loss, and it pretty quickly show the loss compared to the win. So I have these two different trade logs. This year, I'm just using this trade log. But I will share next week. We'll go over how these trade logs work, and I will share these with you. You're welcome to use these or just use them to, if you already have a trade log you're using, you can use these to inspire you if you want to add some data that I've got in here, things like that. I've got a bunch of cells hidden that run some calculations, but I keep track of wins and losses. When I get double stop, like I had one double stop here. I don't think I had another double stop, no. And keep track of the average buying power. It looks like it didn't pick that up. So let me, oh, I know why. But I still have to figure that and work that out. But I enter the entry times, the date, and then the number of contracts in each account. I list the account number. And then for this trade log, I have it feeding into Power BI so I can do the summary data at the end of the day. And I'll share all this with you too when next week when we get into trade logs and stuff, or the week after. I can't remember. It's class 3, the week after. So when I'm entering a trade, did that answer your question about how I'm deciding a choppy day?
Yes, it's more like looking at the chart. It's not so much about volatility or any certain numbers.
Yeah, no. Yeah, and right now VIX is around 14, which is higher than it has been. So I think that's why premiums were better than like they are right now, 25 cents at the end of the day. So I'm gonna go out a day just so premiums are a little higher. And when I'm selecting strikes, normally what I do is if I want to collect, I usually want to collect around $1.25 minimum. And I'd like to be earlier in the day, I can be a little higher premium. Later in the day, it might be a little lower premium, just depending on what's available. I don't like to trade right at the money. I'd rather be several points away. So if I want to collect $1.25 premium, I can't use this option, this 47.95 as the short leg. I've got to go up to the 175, sell that, and then select one down here. If it was the 65, I'd only be collecting $1.25. So I'd probably go down to this 50. So I'm collecting $1.35, $1.40. That's prime real estate in my world. That's generally where I want to be. And I always enter, I look at a 1-minute chart before I enter and see which direction we're moving in. And if we're generally moving down, I will enter the calls first. And then that gives me a few minutes. Maybe it goes down a little bit more and I get a little bit better prices on the puts. But I will look on the put side. Let me get back to the right screen. I will look on the put side and see, okay, if I can collect $1.35 over there, can I get somewhere near that? And it looks like I could. $1.50 and $1 and 40 cent, $1.55 and 40 or 35. This is a day out, so the prices are a little bit different than they would be the day of on a 0 DTE. But that's the idea. I will select a strike that is just somewhere above, just above $1.30, $1.40, and then see how far out I have to go to get a $1.30 premium. You get pretty good at this too after a while. And then I know I can get that on the other side, so I would go ahead and enter that order. And then I will watch it as it enters. I'm not going to enter that one, but if I've got an order sitting there open, I will monitor it. This isn't it. I would monitor it to see where the price is. And if my order gets to be, if I need to reduce my order by 5 cents or so, I might do that. But if it keeps going down pretty strongly, I'll just cancel the order and wait till that move is over. Just wait a minute or so and then re-enter. I don't want to chase prices. I don't want to get in at a price that I later regret that's just too low, like that 65-cent credit that I got. So that's how I do it. I will try to record myself, since you guys don't see me entering these trades in the morning. I'll try to record myself entering some of these trades and then show it at our next class, so you get the idea of entering the trades. And then as soon as I enter the trade, depending on how fast the stock is moving, like sometimes it's really choppy. And as soon as I enter one side, I may go ahead and put the stop on that side. And then I'll enter the other side and then put the stop on that side. And then I'll go back and look at the credits I got and adjust those stops if I need to get 10 cents less on one side than the other side. So it's a process to get those numbers right. So let's just see how we're doing here. Looks like everything's doing fine. So I'm going to be down slightly for today. I'm already down 280 and I only have 0 now to decay. So I have a small loss today. And that was basically because I had one trade that had 50 cents of slippage on it. And that's pretty high for me usually. I usually don't have that much slippage in E-Trade, but some days I do. And that's another reason to do this offset. Sometimes that offset will cover your slippage. And especially, I have found an Interactive Broker, their slippage is high typically. It's very rare that I have a day without 10 cent slippage, 15 cent slippage. Let's look at what, like here's the stop was 160. I got out at 170. Here the stop was 250. I got out at 265. So that's 15 cents of slippage. Here the stop was 220 and it stopped me out at 220. So no slippage there. Here the stop was 260, got me out at 265. So 5 cents of slippage. And then this top one, 10 cents of slippage. And you'll notice that these credits in TAT, you very often can't get, it's very rare that those credits are going to be the same on both sides. So I have TAT set up to add those two credits together and subtract 20 cents to set up the stop. So if you add both of these together, 1.26, I'm looking at these two right here, 126 and 114 is 240, less 20 cents is 220. So same thing here. Now, sometimes on the lower side, I will go in and reduce that stop, because a $1.75 stop on an 86 cent credit, to me, when a 2x stop would normally be $1.60, $1.70, it's too high. Bart, you may want to mute yourself unless you're there. You go. Thanks. Sometimes I'll go in and use a 2 times the initial credit less 10 cents on the lower side and leave the credit that leave the stop that combines the 2 credits on the high side. I have a handout. If all this is clear as mud, I have a handout that describes all these different stops. Yeah, I generally use mid price because it will get me out with less slippage. If I had these stops set for bid or double bid, I would have even more slippage than I typically do. Yeah, and I don't know why IBKR slippage is so high. I just wonder if it's how they handle stops internally, because toss isn't that bad. Toss is pretty good with slippage. And yes, slippage is on the stop. I'm not talking about slippage on entering an order. I'm just talking about slippage like where I want to get out at 275 because that's where I need it to be to make money on one side if I just get stopped out on one side. So when I have 10 cents of slippage, that's why I said in IBKR, I set it 20 cents less than a 2x stop instead of 10 cents less than a 2x stop. But like I said, I have a handout. I'm going to email you guys the handout and some other things after the class so you can see all the different conditions and how I set the stops and why. And it shows calculations for each of those and how each is calculated. Now, you can very well decide to just set your stop at 2 times the initial credit. And I'm fine with that. It makes it very easy to do. And then you don't have to worry about all the 10 cents less and all that. That'd be fine. The idea is just have a stop on zero DTE trades. I just think, especially for this, it could get away from you really fast, and you want to trade with stops on these. So it looks like we're going to slide in, and I'm hopefully not going to have any more stop outs and be good at the end of the day. So I'll have a small loss today just because of the slippage. There's one other thing I wanted to show you guys, and not one other thing, but another thing today. And that's, I've got this M.E.I.C tranche calculator and a drawdown calculator. And this is how you can determine, this is determining the number of contracts you would enter based on the size of your account. And I will send these out to you by email at the end of the day. And some of you may already have these because I know some of you have requested them. But generally what you do, you can enter anything in the blue. So you can enter your account size. Let's say you have an account size of 7,500. I generally don't recommend risking more than 50% of your buying power. But if you want to use less, like 30% of your buying power, you could do that with this calculator and just see how it works out. You can determine the number of tranches you want to enter each day, like 5 or 6 or 4. And at 25, I just use the average width spread. My average spread is probably, sometimes I go as narrow as 5, sometimes as wide as 35, but most of the time it's around 20 to 25. So I just use 25 for this calculator. So even at 25 wide, 6 tranches, using 30% of my buying power, I'm still doing okay as far as buying power is concerned. I'm using 67% of the like I only want to use 30% of my total buying power. So that would be 22,000. By doing 6 tranches at 25 wide, I'm only using 15,000. So that's 67% of the 30% of the buying power that I'm calculating. So therefore, okay. Let's say I want to do 10 tranches and just see what happens. So it comes up with this message: no, reduce the number of contracts or the tranches. Since I'm only trading one contract, I'll reduce the number of contracts. So I could do eight tranches at 1 contract each using 75% of my buying power. So there's the final bell. So we didn't get stopped out, yay. So I'll go log those in later, but we'll just continue on this. So now the buying power is one limiting factor, but the max loss, which would be the loss you would have if you got stopped out of all trades on all sides. So if you entered 8 tranches and you were getting an average of $1.30 credit per tranche, then the total credit received per contract is $1.30, but times the 8 tranches you're entering would be $28.80. And that's actually 2.8% of your account, and that's not including any slippage. So I recommend not risking more than 2% of your account. If you have a smaller account, sometimes that's hard to do, and you might bump that up to 2.5% or 3%. But generally, I'd say keep that around 2%. So we need to reduce the number of tranches. We're okay buying power wise, but we're trading too big for the max loss that we could have. And so I would probably reduce that down to 6. And then that's more reasonable. 2.1% is close enough to 2 that if I stopped out on all sides, my loss would be $1,500. I could stand that $75,000 account. And it just FYI, this doesn't happen very often. I don't think I've ever been stopped out on every trade on all sides. I have been stopped out on every trade but one on all sides, or 2, but never on all sides. So this is the worst case. And the other thing to note is this would be your loss if it was just a really choppy day and you got stopped out on all the puts and all the calls. So you just got to make sure, would you be okay with that size loss? Some people would be fine, and some people would go, ooh, that seems like a lot. You could reduce that even further and just do 5 tranches at 1 contract each. And that would be a 1.7% loss. Maybe $1,300 loss is more reasonable to you. I am very risk averse, so I generally don't risk more than 2% of my account. I try to get that under 2%. And I use generally 30% or less of my buying power each day. And I have several large, they're a couple of $100,000 accounts in TAT and one trading account. And then one of my accounts is over 700,000. So I still don't, I think it's about 720,000 right now. And I'm generally doing 8 contracts and 5 entries. So I've got my loss at 1.4 in that account with an average credit of $1.30. So that would be my max loss. And I could do more, 10 contracts. In fact, for a while I was, but I took a couple of losses in January. January has been a tough month for M.E.I.C. And I don't know if y'all have been watching the Facebook page or the Discord group. And by the way, if you're not a member of the Quantum Options Facebook group or Discord group, I will send out links by email after the class, and feel free to join those. I post my trade results each day, and so you can compare your results to mine, see how you're doing. I also usually post what entry times I'm using. If you look right down here, these are the entry times I'm using. And today I didn't trade that 11:45, so I'm just going to take that off. But and this isn't totaled up yet because I haven't done that, but I'll post that later. But I want to talk a little bit about this max use of total buying power. In my videos, I always say 50% maximum. Now, what that means is that truly is your max risk on your account. You would never, that would be in case of a black swan, all stops were invalid, and you took max loss on every trade, like the width of the spread less the initial credit. That's you could lose the amount of buying power you're using. That is a real risk in options trading. I don't want to minimize the risk and say you can only lose 1.8% or 2%, because I have found with options, weird things can happen. And like COVID, there were a couple of days during 2020 where the market went down 7% in one day, and they halted the market. And in a day where they halt the market, it means your stop has no chance of you can't get out of a trade. The market is closed for business. And in the case of COVID, there were a couple of times where they shut it down for 15 minutes. I think the idea is in a 7% drop in the market, they halt trading for 15 minutes and then they open it back up. And if the market goes down to 12% loss, they halt it again for 15 minutes. And then if they open it back up and if the market continues down, I think at 20%, they just shut it down for the day and close it down for the day. So that means you have no chance of getting out of your trades. Stops won't work. You're just at the mercy of the markets at that point and what happens the next day. And of course, you would just lose on, you could lose depending on where the market opened the next day. I don't even know how they would determine that, but probably where the market would open the next day. You could lose the width of your spread less the initial credit, which is the buying power you're using. Now, in a market that's going down or up, you would just lose on one side, but still that would be a pretty big loss. Excuse me. So I want to reiterate that I've seen strange things happen. And it's the one tricky thing about trading options is that unlike stocks, which stock could open 20% down because the market's 20% down and you would have lost 20% of your stock value, but you wouldn't lose the value of the whole thing. Whereas options, you could lose the value of the whole spread, the width of the spread. So times the number of contracts you're in. So I've seen that happen several times. I saw it happen in COVID. I saw it happen the flash crash in 2011. I happened to be trading then. I wasn't trading options then. I was in some stocks and I was at work and I glanced at the market and it was down something like 250 points when the S&P was only about 1,700 at the time, or maybe 2,000, down 250 points. And I thought, there's got to be something wrong with my computer. I better reboot it. That can't be right. And sure enough, that was right. That was the flash crash. That's why they implemented the circuit breaker rules of if you're down 7%, we halt the market. If you go down another, they halt the market again. And then another 5%, they halt it again and close it for the rest of the day. That was implemented because of the flash crash. What happened is somebody entered some sell orders and the algos, the high frequency traders picked up on that and started selling. And it's one thing led to another. More high frequency traders started selling, and it was just program trading. And that's why they implemented the stop, because they needed some way to stop those computers from feeding off of themselves with a negative feedback loop. Be aware that whatever you risk in buying power, that really is your true risk. Now, that's not, I've seen those kind of weird things happen about once every 10 years. Before that, it was 2008. There was a big drop in the market. This was before circuit breaker rules. And it's not pretty when it happens. To be honest, I haven't ever lost the buying power trading options so far, even in COVID. I don't remember if I was not in a trade those days where it happened to shut down, or if it just stopped me out and my stops worked. That's probably what happened before the circuit breaker went into effect. I was already stopped out. But just be aware the buying power that you're risking is a true risk. The risk on any one day is the intermediate risk that you're taking. That's the more likely risk that could happen. I'd say maybe a 5% chance in any one year of that happening, of losing all trades, both sides being down 2%. So just so you're aware. Any questions about all that?
Yeah, one, would it not make sense then in TAT and in manual trading to really always put the stop only on the short and not on the vertical, to have, in the case of a massive drop down, you have at least a long that will explode in value?
Yeah. Some people can't, their brokers won't allow them to put stops on the spread. So they do have to put stops on the short leg only. You can do that, yes. And that is one protection, because a market stop on a short leg is always going to fill. You may not like the price, but it's always going to fill and get you out. So yes, the answer to your question would be yes, that would be something you could do. But I think too, most days until that, if let's say if we did have a drop of say 250 points in a day, volatility is going to spike up, which is going to increase the value of long options. So it's not likely that you, even if you have a market stop on a spread, it's not likely that wouldn't fill because of a long that's worth less than 5 cents. I feel safe enough just putting stops, a market stop on spreads. I used to only trade with stop loss order, a stop limit order. And that was because there used to be spikes in option prices that would happen every so often, where what CBOE said is that sometimes you'd, like if this was the price of an option, you'd just see a spike up here that was like 30 points high, where the option price spiked 30 points. And the CBOE says that was because a bunch of stops hit and the market makers couldn't work through the orders fast enough. So they would jack up the prices so that to slow down the orders so that they could get through the orders. As of August last year, CBOE implemented some changes in how they handle liquidity with the market makers, where when that happens, they pump liquidity into the market so that we should not see those kind of spikes. Like it just used to happen randomly. It was like the stock wasn't moving and all of a sudden the option price would jack up like 10, 15, $20 for no reason. And that's and then the next minute it'd come back down to normal. So that's why I was using a stop limit order at the time. Now that CBOE has implemented these changes, as of August, I started using market stops, and I have yet to see one of those really bad spikes. Yes, there has been slippage, 50-cent slippage, or occasionally, usually it's one of these spikes, like those big red candles. I guarantee you the option spiked on that red candle. Prices spiked then. It usually the spikes in option prices can be explained by what's happening in the underlying SPX, like this would cause those options to spike. But when it's just motoring along here and nothing's really happening, and you all of a sudden get a price spike in options, if you ever see that, let me know, and let me know the strike, the time, and what you saw the price do, because CBOE has asked us to report that to them. And there's a few of us out there that are collecting that information. And so far, I haven't run across one yet that is not explainable by what's happening in the market. That's going to cause a spike, and not unreasonably, because the options, like if you had the 4760 and you had bought it when the SPX was 20 points away, and all of a sudden SPX is only 3 points away, that price is going to spike up. But if it's unexplained, let me know. Because of those changes, what they do is they The market makers have to fill the orders in tranches, and they're only allowed like a 5 cent, 10 cent movement in the price within that tranche before they can move to the next tranche. And CBOE makes sure that they've got enough liquidity out there that the market makers can fill those orders that they need to fill. And however that works, it has been working because I haven't seen those spikes in option prices. So to answer your question, I feel pretty comfortable about using a market stop on spreads, even with those spikes or even with the threat of a black swan. But if squirrely things start happening in the market, like there was a day early December where something happened with the OPRA, the Option Pricing Regulatory Authority, that is supposed to set option prices, and it just went haywire. And prices were just weird. And that happened early in the morning. And luckily, I wasn't trading at the time, but I heard about it. People were talking about it in the Facebook groups and Discord groups about what pricing they were seeing, that they were getting stopped out and the price wasn't moving at all. And that was just a technical difficulty. Unfortunately, options are just prone to that because they're susceptible to any little movement in the stock or any uncertainty in the stock prices. So it could happen. But I feel fairly comfortable just setting market stops now. I'm glad I'm using market stops, not stop limit orders, because if something weird happened, stop limit orders can be blown through and you'd have to step in and manually close those. So that should work a little bit better. Now, there was another thing I wanted to talk about, this drawdown calculator. What this is it is a way, you know, that drawdown photograph I showed, or drawdown image. Let me go back to that. Nope. Where is that? Let me find it. Must be up here. I thought it was right there. There. If you're trading M.E.I.C and you start in one of these drawdowns, like in my experience, I haven't had more than a 3% drawdown. But I have seen people who they're trading larger, they're trading probably more contracts than I would be for their account size. And they can end up in a drawdown of like 10% or so before they start coming out of it. In that case, this is a protection against a larger drawdown. I'm gonna enter a few values so we've got some things to look at here. Let's just say 2/1/2023, and the equity value. Let's say we went up to 100,000. It's probably not likely, but 130, and we're doing 5 entries, 25 wide, and this tells us how many contracts we can trade, and it tells you the risk. So, you know, that 2 contracts gives you a 2.6% risk per day. You could verify that over here if that's right. So that may be too much, but it's really used for a different purpose here. I'm going to fill in a few more of these. 2023. Let's say we went to 150,000. That would be nice if we were making 50,000 a month on these. And then all of a sudden, let's say April 2023, we went down to 125 or 125. There. This would say, okay, you're in a drawdown, 16% drawdown from the high there. Go back to trading 1 contract. And this will protect you from this. This would keep you from ever having greater than a 25% drawdown. You could set this down to 10% drawdown and it would say stop trading. Like a -1 contract to trade would mean you're in a greater than 10% drawdown. Let's say 20% drawdown. And there, even it would say stop trading. And I've got it set to 25%. That's my maximum. If I lost 25% of my account, I would probably stop trading at that point. But this will protect you in that as your account gains and loses, let's 2023, let's make it a little more realistic. Let's say you ended up in a 20% drawdown. Even then, it's just saying one. And these are dependent on how many tranches you're entering too, because you could change to 6 tranches, and it's only allowing you to enter 2 contracts at $150,000, and then it takes you back to 1 when you've had a 13% drawdown. But then let's say we go back up to 160, and then we're back up to 2. And this value is dependent on the risk, the average credit per trade. And that can vary. Like at the first of last year, my average trade was probably $1.50. And you'll notice trading all of these change based on that. So I usually, if I change the number of tranches, then I'm just looking at this last entry because it could affect these earlier entries too. And then let's say 170, and then we go back to 150. Let's see what it does. So we're back down to 1. That's gonna, and let's see if we, now here, if our average credit was only 1 and our risk is 67%, I was in a 11% drawdown from that point. I would have a tough time going down to 1 contract and only risking 0.67 in my account. I might actually override this and decide to trade 2 and risking 1.3 of my account, which is I've cut down by 1. The max number of contracts I was trading was 3. So anyway, the idea behind this is if you get in a drawdown, this will help you make the decision about how many contracts to trade. You can override it. It's just a guideline, but it is there to help you. What I do when I start, if I have a couple of losing days in a row, I will start reducing the number of contracts I trade because I do trade larger accounts. That's how that works. And let's say if I was only entering 4 tranches, it would give me more contracts to trade. It just depends on the size of that drawdown and what my maximum drawdown set. Let's say I allowed a 50% drawdown, then it's going to allow me to trade more contracts. And even though I've ended up in 13% drawdown, it only had me reduce the contract size by 2, but my risk per day based on that number of contracts is pretty high. So I would rather follow this and keep it less than 2% than follow this. So I'm going to send these out and you guys can play with them. But the idea is to, if you start getting in a drawdown, start reducing the number of contracts you're trading. Or if you're already reduced to 1 contract, you can reduce the number of tranches you're entering and play it that way. So you could manipulate this and enter 4 tranches at 5 contracts each. Let's say 500,000. Let's see what this gives you. 50%. Yeah. If I was entering 4 tranches at 5 contracts each on that size account, I'd be risking 1%. So that I'd be very comfortable with that, but I'd probably enter more tranches or more contracts and 6 contracts and get that closer to 2. Oh, one other thing. I did show you this where I write down the trades and then I just have that as my manual log. And then when I have time, I go enter that in my actual trade log here. Let's see, I had another stop out there on that one, 2.35, 0.95. You can see on that trade, that last trade we entered, I made about $6, $5 on that entry because I lost on one side, gained on the other. Anyway, any questions about any of that?
I put something in the chat a little while back about
Oh, okay. I may have missed.
about the 10-cent difference. I'm just wondering if you have any sense of how many additional stops you get from the cents.
To be honest, I have a friend who trades at purely a 2x stop. And for a while, we were using the same entry times. And it was very rare that I was getting stopped out and he wasn't getting stopped out. It just was very rare. It has a small impact, I think, I theoretically, when I've back tested this, I can't back test with the 10-cent off of my strike in BYOB. And I'll talk about that and how to back test next week. But so I can always go back and compare my results to BYOB. And when I do that, my win rate is about 55% on BYOB. My actual win rate is closer to 52%. So I think it has about a 3.3% impact on the number of stops that I get. But so that's my best estimate. And just based on going back and back testing the same period that I have live traded. Now, there's always going to be some differences in back testing and live trading. Sometimes it won't pick up a stop in back test that it would hit you with, or vice versa. Yeah, that's about what I see.
Thank you.
And also, just another number that I see just while we're talking is the number of double stops. Oops. That I keep track of them, is about 5% of all the iron condors I enter ends up in a double stop. So that means it really would be 10% of the trades, since I just count one double stop per iron condor. So about 5% of the trade entries on both sides get stopped out on both sides. So that's pretty rare. And that's where this shows that would be 100%. This was back test results. It showed from 2019 to 2022, 3 days stopped out on all trades on all sides. Three days. 11 days, 90% of the trades stopped out. And these are more and more double stops each time. So this is one double stop, two double stops, three double stops. And so you can see this was back testing. I think 2023, I need to run these numbers again because this was through May. And, that I'll do that. Let me make myself a note. Run live trading for stop outs for number of trades stopped out. This was through May, and I had this in the video. 42% of the days are profitable. 3% are losing days, where I'm losing on one more trade lost than win. So I had a loss for the day. And 35% of the days are break even. So even though the way I'm setting my stops really would affect those break even trades, because I guess you could end up with one more stop out there. But the thing about the M.E.I.C plus is, with the 10-cent offset, I'm trying to make basically $10 a trade on those 35% of the trades that I'm doing. In this case, that was about 90 trades there. So $30 times 90 trades times $10 each would be $900 on those break-even trades. I can make a ton of money just on the break-even days. It helps compensate for the win rate. The win rate on this trade is a low win rate. Like, I've never traded something that was a 52% win rate before and made the kind of money that I've made last year. My total gain last year was total across all accounts was $272,000. And that's just incredible to me, to make that kind of money on a 50%, 52% win rate. And it's just because those little wins add up. They really do. And then not having big drawdowns that you're having to recoup a bunch of losses from. Trying to be careful and not trade on FOMC days and avoid choppy days. Things like that can help. There was my vacation. I took 2 weeks off in September. So there's my vacation. And some days are really good too. So win on all days on some of these. And April was especially a good month last year. And January was a poor month last year too. You can see I struggled to be break even last January. And that was one of my higher losses, was the first day trading in January. Anyway, I think that's about it for today. We may just call it a day unless there's more questions. Let me look through.
Yeah. One question: are you trading only M.E.I.C, or in TAT we have the discussion, and I'm also doing it now, is all the different strategies, EMA and
the moving average.
Only.
I last year I only traded M.E.I.C because I wanted to devote full time to it and really understand the power of that trade. And this year I'm toying with the idea of doing some other trades, like the 111 trade or 112 trade that people talk about, where you're selling an out of the money put and buying a debit spread as protection. I may enter some of those. I may do some of the, I haven't been able to test the EMA trade to find a good setting for that on TAT. But yeah, TAT will also trade iron flies, the EMA. I just haven't done it. So I can't share any experiences there. Probably if you trade via TAT, you also have access to the TAT Discord group, which is a really good Discord group. There's a lot of good traders in there, and a lot of traders trading a lot of different ways too. And let's see if I'm missing any questions here in chat. Don't think so. Yeah, I just haven't gotten into that yet. And this year I'm hoping to. I'm hoping to broaden my horizons. It'll probably be after I get through this class. And this is the last class I'm going to do live. And then it's back to my regular trading schedule and doing that. So I may be with you in trying out some of those other trades. The EMA would be great on trending days. It probably, I've seen people lose a lot of money with it too on choppy days. So it's not so good on choppy days. But if you see it's trending and it just seems like it's going to be a trendy day, sometimes it's hard to tell. And the flies, the thing I've seen about flies is the drawdowns can be high on those. I have a friend who trades iron flies. He doesn't use TAT to trade them, but he has his Dale Perryman. Some of you may know him. He trades flies, and he has a Discord group where he talks about his strategy. He has good rules, outlined rules for when to enter, how to manage them. And he's had me do some analysis for him, Monte Carlo analysis and things like that. But what I've observed in his live trading is he's had as high as a 50% drawdown. Most people psychologically couldn't tolerate a 50% drawdown. So that is tough. I would hesitate to enter that next trade. I just don't think I could do it. And to continue to trade when you've had that kind of loss, and to know you could have 100% drawdown, you could lose it all, you could lose everything you gained. I have wanted to look at flies and see if there's a way to somehow use stops or some set of rules that will reduce that kind of drawdown on flies. It's just that's too big a drawdown for me as a conservative trader to tolerate. I just couldn't tolerate it. We'll have to check with some of the fly traders in the TAT group and see if they found a way to deal with that, or some settings that work. Any other questions, or just about the M.E.I.C. Is everybody in the chat, let me know if you haven't traded M.E.I.C. before, you haven't dabbled in it, you're waiting for this class before you jump in, or if you have traded it a little bit, just let me know. I just want to get a feel for the experience level with this trade in the group. And Neil hasn't traded it, just beginning. Okay, so Byron for about 6 months. That's good. Yeah, now with TAT only. I'm getting ready to move some more money to TAT and have it be a bigger percentage of my account. Paper trading is a great way to start. Yes. And you can do that in TAT too. When you start out, if you're interested in automated trading, M.E.I.C. is great for automated trading because it follows a set of rules. And TAT was designed to trade M.E.I.C. Kyle Leesman, I met him through another group, and he was doing some backtesting for us in that group. And then he started backtesting the M.E.I.C. And then he developed TAT just to trade M.E.I.C. because he had a full-time job and wanted to be able to trade M.E.I.C. So it's great for trading it. I think my return with TAT is almost as good as manual trading. I'm a little better. My trading results are a little better in manual trading. And I really think that is purely because slippage is higher and fees are higher in IBKR. They're a little more than twice what I pay in E-Trade. E-Trade, I pay 62 cents a contract, and that includes the SPX cost. I pay 10 cents a contract, excuse me, for options, and then add 52 cents, excuse me, for CBOE. It is cold here. I'm going to turn my heater up a little bit. I realize that's why I'm sneezing. No, I usually don't. Some people do, and I just purely use the price. And if you do that every day, you get a sense of, in higher volatility times, you can tell the prices are getting higher and you can trade with more premium. And then in lower volatility times, the premium goes down. So indirectly, I'm using standard deviation just by targeting price. So because the lower the volatility, the closer I'm going to get to the strike, to the money, and the higher the volatility, the further away I'm going to be from the money. So it naturally flows from that. But I think it'd be fine if you do use standard deviation or the expected move. I just don't have, E-Trade doesn't show the expected move on their option chain. TOS does. So TOS and Tasty Trade, I think both show the standard deviation. But yeah, at Interactive Broker, the fees, it's actually $1.48 a contract and maybe $1.28, depending on whether if you're trading only one contract of SPX. And so that's why I trade 3 contracts. If you trade 2 or more, you get a better deal in the charges, the fees that they charge you. With 2 or more, they charge you, let me look it up what it is because I forget. Have it in here. Second, let me unhide these columns. Yeah, 128 for option prices over $1 and 119 for option prices less than $1. That's if you trade more than two or more contracts, and they don't negotiate with you. E-Trade will negotiate with you. So most people wouldn't be able to get the 62% rate. I used to be an option house user before E-Trade bought them, and E-Trade bought them, and they've always offered me great fees because of that. They wanted to keep our business. I ran into a couple of people who were option house users who also use E-Trade now because of that, because the fees are less than any other broker. I think Fidelity doesn't charge for SPX trades, but they also are a really lousy broker for options trades. If you try to enter a spread and then set the stop on the short leg, they jack your margin requirements way up. So I really do not recommend Fidelity as an option broker. On TAT, actually, I probably trade TAT more than I do manual on noisy days. So that, Byron, you would think that, but it doesn't quite make sense. It may mean that I should enter on choppy days when I'm not entering in manual trading. So I probably tend to enter TAT and let it do its thing because I trust it to manage it for me very well. We'll go ahead and call it a day here, and I'll send out the handouts, some information on setting stops, and you can read through that. I'll send the links for the Discord and the Facebook groups, and you're welcome to join those and chat with other M.E.I.C traders. There's a lot of us in those groups. Next time, we'll go over back testing, both using option Omega and using BYOB. I cover both of those. And then I'll also show you how to use TAT if you're not already signed up for it. And because I really do recommend it. It's great to be able to trade, especially for those of you who may have jobs and can't devote a lot of screen time to this trade. And it's really good for that. And then the following week, next week in backtesting, I'll go over a little bit about how I select my entry times each month. And just to let you know, my entry times this month are 11:45, 12:15, 12:45, 1:15, and 1:45. So basically 11:45 Central Time and every 30 minutes thereafter seem to be the best. And it seems like those times have continued to work out good so far this month. I'll continue to use those and just continue to test them at the end of each month. And I'll show you how I do my testing and how that works out. And then the third class, I'll go a little more into the monthly back testing and setting up trades. And then we'll talk about the trade logs and the different ones that I use and what the advantages and disadvantages are. And I'll share these with you. So you've got these. And then we'll get into I also have a video like you're seeing me trading live at the end of the day where I tighten my stops. I take the stop off the legs that have are worth less than 5 cents. All of that you saw me do today. I have a little video that goes. It's a great day because a lot was happening that day. So that's another thing that I'll show. And in the last session, I talk about when things go wrong, what kinds of things can go wrong with this trade. And I've probably made all the mistakes, hopefully, that you can make on this, and entry errors and errors entering my stops or stop out errors and broker errors and things like that. And just a lot of other things. So feel free to save up your questions and ask me questions. I don't mind at all. I've set this up so there's lots of discussion. Yeah, I'm learning there are different triggers for stops. I'm wondering if I could use mid, if it might be better. I personally prefer mid price on stops, and I think that gets you out sooner and causes less slippage. When you get out, it's easy to show on TAT. Here, like when you set it up to get you out at the bid price, then it's like the bid price has to hit your stop, and you actually get filled closer to the ask price, so it can lead to higher slippage. And that's my understanding of it. I would not set a stop on the bid. There in IBKR, you can also set it on double bid. Require 2 prices to hit at 250 on the bid. By the time this hits, let's say if it was here, by the time this hit 220, this would probably be at 260 or so. So it'd be much higher price. You're going to get filled somewhere between the two. So it creates more slippage. So I think if I could get out on the ask, the second the ask price becomes the stop, I would do it. IBKR doesn't offer that, or TAT doesn't offer that. It just offers the mid price. And the reason is anybody could fat finger an ask price and say, get me out at $10, or I'll enter a trade at $10, and it would automatically fill. So bad idea. I prefer mid price. E-Trade, I don't have a choice. So I think it just says it goes for the national NBBO, national best bid offer. And it seems to get me filled with less slippage than E-Trade. So about half and half. Some people with experience and some people who haven't tried it yet. So I would suggest try paper trading it if you haven't traded M.E.I.C, and have some questions for next time that we can go over. If you have questions about how to decide, you can't get your credits even on both sides. I find that it's easier trading multiple contracts to get credits even on both sides, like I was showing you with this one example, because I could get $65, 65 cents on one side and 80 cents on the other. If I trade 5 contracts, my total net credit received is almost equal. So it's easier to manipulate the number of contracts and to get those to be closer. If I was just trading one contract, I couldn't do that. And then I would have to use the technique of just combining the credits, combining the credits and subtracting 10 cents. So if I combine the credits, that would be 145, and subtract 10 cents. A stop on that side would get me out at $71. So I'd make $7 on that trade. And then if I got stopped out on this side, I'd make about $9, $7 looks like, if I got stopped out on that side. So either way, by combining the credits and subtracting 10 cents, I'm still achieving the goal of the M.E.I.C plus, which is make a little bit of money on break-even trades. So it's just easier to do that if I can manipulate the number of contracts, although I have to know in advance what I'm getting on one side to get that on the other. And vice versa. Today, let's see if I could have gone because I had entered the calls first. If I had entered the call first and then realized it, I could have been closer and just done 3 contracts of the 80. That would have gotten me closer. My risk would have been on the call side. And ultimately, I did get stopped out on the put side. So I would have automatically made a little bit more money that way. But anyway, this handout that I'm going to send you covers a lot of different situations like that and shows you how to handle it. So we'll call it a day. I keep saying that. We definitely will now. It's almost 4 o'clock. So thanks everybody for attending. Looking forward to next week, same time, same place. And try a little bit of paper trading, or if you're already into live trading, try some of those stop techniques and see if that helps you out in helping to balance the credits and the stops and the wins and losses that you're having on each side, so that you can make some money on those break-even trades. There's a lot of break-even trades. I'm going to run the numbers and update those charts, and I'll have those for next time so we can see what January through December looks like in terms of number of winning days, losing days, and break-even days. So it should be good.
Thank you so much, Tammy. I appreciate everyone being here. Have a good rest of your week, and we'll talk to you soon.
Okay. Bye-bye.
Bye-bye.